we have focused a great deal of U.S. effort on our weak commercial shipbuilding industry. On the other hand, China has just announced an order for warships. What's happening to the shipping industry? China signs the largest domestic shipbuilding contract in history. Hello, welcome to Two Nations Money Talk. China's state-owned shipbuilding corporation, CSSC, has signed the largest domestic shipbuilding contract in Chinese history, securing an order for 87 ships worth approximately 50 billion yuan, equivalent to $7.1 billion, from China COSCO. Asterisk. What impact did this have on the United States? Well, asterisk, a dramatic increase in ship size and then a steady output of around 15 to 20 million tons per year. Asterisk. But then, starting around 1995, we saw the industry boom, peaking sharply just after 2010. Notice who was building these ships. Europe almost completely disappeared. Japan was actually one of the major shipbuilders, but their market share began to decline. We focused heavily on the U.S. effort to revive its struggling commercial shipbuilding industry. The South Korean shipbuilding industry boomed in the 1980 seconds, peaking in the 2010 seconds, but then from the 1990 seconds to the 2000s, we saw the rise of China. Each year, China imports approximately 66,000 tons of butter. This volume is equivalent to about 6.5 famous buildings in Paris, or, if you prefer, equivalent to 440 blue whales. And most of this butter comes from Peru. This journey used to take over a month. Now, it's transported directly, shortening the time to 10 days. Why? Just one word: superports. Asterisk. China's ambition to directly compete with the United States in the shipbuilding and shipping industries. For much of the last decade, analysts focused on semiconductors, EV supply chains, and rare earths as the primary arenas of U.S.-China strategic rivalry. Yet a quieter, more structural confrontation has been unfolding far from public view, one that begins not in the factories of Guangdong or the data centers of Virginia, but at sea. The maritime sector, ports, shipping lanes, and the vast industrial ecosystem of global shipbuilding has become the new pressure point in the contest for economic primacy. And the underlying signals suggest that a shift in industrial hierarchy is no longer speculative, it is material, measured, and accelerating. Washington's anxiety is rooted in numbers that rarely appear in political speeches, yet shape the foundation of global power. China now produces over half of the world's commercial vessels, dominates the construction of container ships, and is expanding aggressively into dual-use shipbuilding that blurs the boundaries between commercial scale and naval capability. The U.S., meanwhile, builds less than 1% of global commercial tonnage, an imbalance so sharp that it challenges not just competitiveness, but predictability, a value that long underpinned the American-led economic order. A quiet recalibration began when U.S. intelligence assessments flagged a pattern. Chinese state-backed shipyards were integrating advanced sensors, satellite linkages, and energy-efficient propulsion systems into commercial hulls technologies with clear military spillover potential. For decades, Beijing viewed maritime infrastructure as a logistical necessity. Today, it sees it as a strategic lever. Ports as geopolitical footholds, shipping as data-rich corridors, shipyards as engines of national resilience. In this emerging architecture, trade and security no longer operate on parallel tracks but converge into a single, vertically integrated power instrument. America's response has been reactive, fragmented, and constrained by domestic political cycles. Attempts to reshore shipbuilding capacity have struggled against cost structures shaped by decades of offshoring, while port modernization plans compete with polarized fiscal debates. The Trans-Pacific Security Alliance still offers Washington some leverage, but the economic dimension, containers moved, ships delivered, infrastructure financed, tilts increasingly toward Beijing. For allies in the transatlantic bloc, this is more than an economic signal. It is a warning that the supply chain re-architecture of the next decade may operate with China as the gravitational center rather than the U.S. Moreover, China's maritime footprint is no longer confined to Asia. From Piraeus to Djibouti to Sao Paulo, Chinese-financed port infrastructure is embedding Beijing's preferences deep into global choke points. These investments form a network, not yet a block, but a constellation of influence capable of reshaping routing patterns, insurance pricing, and even the risk models used by Western logistics firms. It is a subtle evolution, but one that erodes America's once unquestioned position as the system's ultimate coordinator. For U.S. policymakers, the uncomfortable truth is that maritime power is returning as the foundation of economic power. The world's largest economy is increasingly dependent on foreign-controlled vessels operating through foreign-controlled ports under foreign-influenced logistics networks. This is not yet a crisis, but it is a structural vulnerability, one that adversaries can exploit, markets can price in, and allies can quietly hedge against. The question haunting Washington's strategic circles is no longer whether China seeks to challenge American primacy at sea. The more unsettling question is whether the challenge has already matured beyond the point where traditional policy tools can restore the balance. And if the maritime front is merely the first domino, what will fall next? How China's expanding port and shipbuilding ecosystem is quietly reconfiguring global power relations. What looks, on the surface, like a series of commercial investments has evolved into a geo-economic operating system, one that increasingly shapes how goods move, how insurers price risk, and how governments interpret strategic intent. China's state-linked port operators now hold stakes in more than 90 overseas terminals. Analysts often frame these assets as logistical conveniences, but they function more like political sensors, nodes that feed Beijing granular data on cargo flows, shipping densities, bottlenecks, and price fluctuations. Access to this information introduces an asymmetry rarely acknowledged in Western policy debates: the ability to anticipate the world's economic pulse in near real time. In a hyper-fragmented global economy, such foresight is not a luxury, it is strategic currency. Yet the more consequential shift lies in the alignment between China's port strategy and its industrial base. While the U.S. continues to treat maritime infrastructure as a siloed sector, China views it as the connective tissue binding together its broader ambitions: energy security, export stability, and naval projection. This is not simply port building, it is supply chain re-architecture with Chinese characteristics, embedding Beijing's preferences into the connective circuits of global trade. Global shippers are quietly adjusting. European carriers now rely on Chinese-built megaships as operational defaults, while Latin American exporters increasingly route through Chinese-operated ports because of lower fees and more predictable scheduling. These operational decisions, pragmatic, cost-driven, incremental, aggregate into a shift in the world's industrial hierarchy. China becomes not just a factory of the world, but the dispatcher of the world, determining which goods move first, cheapest, and most reliably. Meanwhile, the U.S. faces a paradox. Its ports are among the world's busiest, yet also among the least modernized. Years of underinvestment, regulatory bottlenecks, and political oscillation have produced an infrastructure landscape better suited to the early 2000s than the geopolitical demands of the 2022s. The maritime industry's leaders warn of diminishing predictability once America's strongest competitive asset. When schedules become unpredictable, supply chains hedge, and when supply chains hedge, they move. This structural lag is becoming painfully visible in the naval-industrial complex. Whereas China can scale dual-use shipbuilding at a pace reminiscent of Cold War-era industrial mobilization, the U.S. Navy struggles with delays, labor shortages, and budget overruns. The result is not merely a military imbalance, but an industrial credibility gap, a widening distance between what the U.S. needs to produce and what it can produce. Allies see this. Canadian officials privately express concern over America's eroding maritime production capability, even as they deepen cooperation on critical minerals and continental security. European governments, facing their own strategic dependencies, are increasingly torn between aligning with the U.S. for security and with China for commercial survival. Southeast Asian states, meanwhile, navigate the shifting tides with a blend of caution and opportunism, leveraging the rivalry to extract infrastructure deals and defense commitments. The silent, unnerving truth is that America's maritime weakness is becoming a global reference point. Markets are beginning to price it, analysts are beginning to quantify it, and governments, some quietly, some bluntly, are beginning to plan for a world where China shapes the maritime commons. The question is no longer whether ports matter, they do. The real question is whether the U.S. still has the industrial and political will to rebuild the maritime foundations on which its economic primacy once stood. Shipbuilding, the industrial heartbeat that determines who ultimately commands global trade, naval presence, and economic coercive capacity. The world talks endlessly about semiconductor fabs and EV factories, yet shipyards far less glamorous, far more deterministic, are emerging as the decisive indicator of long-term power projection. What the data reveals is stark. China now builds more ships annually than the United States, Japan, and South Korea combined. Its shipbuilding output is not merely larger, it is strategically synchronized. State-owned giants like CSSC operate with a level of vertical integration that U.S. yards haven't possessed since the mid-20th century. Steel, sensors, propulsion systems, civilian hulls, naval hulls, crew training, financing, even insurance packages, each component nested within a centrally engineered industrial hierarchy. It is an architecture designed for scale, predictability, and strategic ambiguity. American shipyards, by contrast, have become symbols of industrial fatigue. Chronic backlogs, fragmented supply networks, insufficient dry dock capacity, and a workforce pipeline weakened by decades of outsourcing have created a structural drag that no emergency funding package can swiftly correct. The U.S. Navy's modernization strategy routinely slips by 3-7 years, while China can commission entire classes of vessels in the time it takes America to finalize procurement paperwork. This is not merely a tactical delay. It represents a widening temporal disadvantage, one that compounds each year it remains unaddressed. Yet the most consequential imbalance is not numerical, but conceptual. Beijing's shipbuilding strategy treats commercial and naval production as two faces of the same industrial coin. A container vessel rolling off a Shanghai line is built under the same technological and managerial ecosystem that produces frigates and amphibious ships. Dual-use capability is not a loophole, it is the operating principle. And because global shipping is increasingly reliant on Chinese hulls, Beijing's commercial dominance inherently generates military optionality. Washington's policy community is beginning to grasp this. Classified assessments, leaked in fragments, warn that the U is entering what some analysts describe as a strategic overhang, a moment when America's military doctrine presupposes industrial capacities the nation no longer possesses. The Pentagon can design sophisticated vessels, but cannot produce them at geopolitical speed. Allies sense this lag. Asian partners and NATO members alike whisper the same concern. America's deterrence credibility is increasingly constrained by its industrial throughput. Meanwhile, China is accelerating a shift that could redefine the maritime balance. The integration of AI-assisted fabrication, automated hull welding, and predictive maintenance platforms. This fusion compresses timelines and reduces error rates, allowing China to iterate ship designs at a pace that mirrors the evolution of consumer electronics more than traditional industrial cycles. These techniques ripple outward, affecting shipping rates, fleet reliability, and the global logistics confidence index. As Beijing scales this model, it is not just building ships, it is building the future cost structure of maritime economic power. For investors and policymakers, the emerging risk is subtle but profound. Once China's production ecosystem becomes the global default, the cost of decoupling or even mild diversification skyrockets. Much as the world became locked into China-centric electronics production in the 2010 seconds, it now faces the prospect of being locked into China-centric maritime production in the 2020 seconds and 2030 seconds. The U.S. can still reverse course, but doing so requires what America currently lacks: bipartisan industrial strategy, long-horizon capital discipline, labor force regeneration, and a redefinition of national security, extending well beyond missile counts and carrier groups. It requires a recognition that shipyards are not relics, they are strategic arsenals, shaping a world where influence flows not from declarations, but from steel, logistics, and the vessels that bind continents together. The uncomfortable question that emerges is this: if industrial momentum, not intentions, not diplomacy, is becoming the true measure of geopolitical power, is the U.S. prepared for what the next decade will demand? If shipyards reveal the industrial imbalance, ports and the incentives threaded through them reveal the geopolitical leverage that follows. To understand the coming decade of U.S.-China rivalry, one must look beyond tariff schedules and warship counts to the quieter battle unfolding across global maritime choke points. These are not merely logistical nodes. They are platforms of political influence, data acquisition, and economic gatekeeping. And Beijing has positioned itself with a patience Washington no longer practices. Over the past 20 years, Chinese firms, state-owned or state-guided, have embedded themselves into 100-plus ports, forming a lattice that mirrors not only China's trade flows but its strategic anxieties. This network is concentrated around routes where disruption would reverberate instantly. The Strait of Malacca, the Suez Corridor, East African gateways, the Panama-Caribbean Belt, and key European terminals. Each port looks commercial, each contract appears regulatory, each joint venture reads like a standard infrastructure deal, yet the cumulative effect is unmistakable. Beijing has constructed an external logistics sphere that grants it optionality in both peace and crisis. The United States, by contrast, still relies on a legacy assumption that global maritime arteries will remain neutral, open, and self-governing. But neutrality is not a natural condition. It is an outcome produced by power, presence, and incentives. And here the asymmetry becomes politically consequential. China's port operators do not need to control a canal or blockade a strait to exert leverage. Influence can manifest in softer forms: priority docking for friendly nations, delayed clearance for adversarial cargoes, data sharing arrangements that map global supply patterns, or regulatory decisions that subtly raise costs for U.S. aligned shipping lines. This is the new grammar of maritime power: incremental, deniable, commercially framed. Washington is discovering that strategic coercion in the 21st century rarely looks like the Cold War's binary brinkmanship. It looks like a container ship held for inspection. It looks like trade routing shaped by port incentives. It looks like a logistics ecosystem where each micro-friction compounds into macro vulnerability. Nowhere is this more visible than in Latin America. The Chanche port in Peru, financed and majority operated by Chinese entities, is not simply a trade hub. It is a quiet pivot point that could rewire South America's economic orientation. By compressing transit times to China and lowering freight costs, Chanche reframes comparative advantage across the entire Pacific coast. This is how alignment shifts today, not through treaties, but through the gravitational pull of infrastructure. If supply chain rearchitecture is the defining motif of this era, Beijing is writing the blueprint. Europe is awakening belatedly. Investment screening rules now attempt to limit Chinese access to critical port assets, yet much of the entanglement has already occurred. From Piraeus to Zeebrugge, Chinese operators have demonstrated a level of capital scale and operational efficiency that European governments, mired in political fragmentation and fiscal restraint, struggle to match. The transatlantic bloc is beginning to coordinate, but coordination rarely outruns embedded economic reality. The deeper risk, especially for the United States, lies in predictability erosion. Global trade depends not only on ships and ports, but on the shared expectation that maritime flows remain insulated from geopolitical bargaining. China's expanding port footprint subtly alters that expectation. It seeds doubt. It introduces the possibility, however remote, that access, speed, or routing might someday hinge on political posture. Even the perception of such vulnerability can shift investment patterns and alter supply chains long before any crisis materializes. For investors, supply chain strategists, and policymakers, the question is no longer whether maritime infrastructure can be weaponized. It is how quietly such weaponization would occur, and how early signals would be detected. The global commons narrative is giving way to a reality where logistics corridors behave like geopolitical assets, not universal goods. And so, as the U.S. focuses on tariffs, export controls, and naval deployments, an uncomfortable consideration emerges. Has Washington underestimated the degree to which influence in the coming era will be exercised not on open oceans, but within the narrow bottlenecks and private terminals where commercial decisions quietly shape geopolitical outcomes? As we reach the final layer of this analysis, a broader transformation comes into focus. The U.China confrontation in shipbuilding, ports, and maritime logistics is not an isolated episode. It is the early phase of a deeper global realignment, one that will reorder economic hierarchies, alliance structures, and even the psychological architecture of global markets. For decades, the assumption underpinning the world economy was that America's maritime dominance would remain as permanent as the dollar itself. That assumption is now fraying. The symbolism is hard to ignore. While Washington debates short-term appropriations, Beijing lays down steel in quantities reminiscent of 20th century superpowers. While U.S. policymakers argue over procurement schedules, Chinese contractors unveil a new megaport every quarter, often in regions where American engagement has thinned. The shift is not yet decisive, but it is directional, and the direction matters. Maritime capacity is not simply infrastructure. It is strategic time converted into physical form. Crucially, China's maritime surge is reshaping the alliances that once underpinned American leadership. Countries like Peru, Kenya, Greece, and Cambodia are not drifting toward Beijing because of ideological conversion, but because of infrastructural gravity. Where capital flows, political deference often follows. Where trade routes shorten, national strategy subtly recalibrates. The world is experiencing a quiet, infrastructure-led non-alignment, a recalibration driven less by military pressure and more by credible investment, predictable delivery, and an alternative vision of global order. Meanwhile, U.S. partners observe, with growing unease, the widening gap between American strategic rhetoric and industrial reality. The United States can still provide security guarantees, but security without logistics is increasingly inadequate. A transatlantic bloc cannot sustain its credibility if it depends on Chinese-built vessels to transport its goods or Chinese-operated terminals to distribute them. Europe voices this contradiction in closed-door forums. Southeast Asia lives it daily. Latin America is beginning to articulate it diplomatically. The geopolitical consequences are profound. If China becomes the world's indispensable maritime operator, it will possess a form of influence that does not require explicit coercion. Investors would hedge political risk by aligning with Chinese port networks. Commodity exporters would prioritize routing that preserves access to Chinese markets. Even U.S. corporations steeped in decades of optimizing for efficiency would feel compelled to adapt to Beijing's logistical ecosystem. In such an environment, American leverage would erode not through conflict, but through irrelevance. This is where the United States faces the most urgent structural test: rebuilding industrial stamina. Without a revitalized shipbuilding base, expanded dry dock capacity, and a coordinated port modernization strategy, the U.S. risks entering a decade in which its hard power capabilities outpace its economic arteries, a mismatch that history has repeatedly punished. Industrial scarcity becomes strategic scarcity. Strategic scarcity becomes geopolitical concession. But even as Washington grapples with industrial decline, a second challenge emerges: the rise of middle power assertiveness. States like Canada, Australia, and the Netherlands are beginning to resist U.S. commercial dominance and craft their own trade and infrastructure strategies. Canada, in particular, is quietly repositioning itself not merely as America's adjunct, but as a resource-rich, logistics-critical, politically stable alternative supplier in an era of fractured supply chains. Ottawa's bet is subtle, yet unmistakable. A future where North America is no longer synonymous with the United States alone. This shift, long overlooked in Washington, raises an uncomfortable strategic possibility. America may soon find that its closest neighbors are not automatically aligned with its economic worldview. As global trade patterns reconfigure around non-U.S. hubs, the North American hierarchy itself could begin to tilt, which brings us to the final, unavoidable question, one that hangs over boardrooms, policy circles, and intelligence assessments alike. If the next era of global power will be decided not by ideology or military alliances, but by who controls the arteries of maritime commerce, then what happens if the United States wakes up one day and discovers those arteries no longer flow through it?